Hey guys, it's Sasha. The latest US inflation data just came in and inflation went down slightly to 3.4%, up 0.3% month on month. There are two big problems with this inflation data. The first big problem is that the real level of inflation in the US right now is at 2.6% or thereabouts, and there are only really two major factors that are keeping that rate above 2% in the first place: high energy prices and high car insurance. Both of these are high not because of a systemic inflationary pressure pushing them up, not because of some fundamental serious problem, but because these sectors are busy profiteering under the guise of inflation. I'll explain all of this in some detail. And the second big problem with this inflation data is that a lot of Tweedledums on the internet will keep shouting that inflation is sticky, it's a big problem. Oh no, the media loves to do this, and real estate agents with small peepees do it because panic sells. When your channel dies, nobody wants to go and watch your videos anymore. The only thing you can do is shout loudly about stuff you don't know anything about.
The point is, to me, real estate's freaking easy because I look at this stuff and I go, I know what to do. Stocks, I don't know. So don't ever expect Meet Kevin to sell you a stock investing course.
So let's talk about the actual data. And by data, I mean the important data, the large items in inflation that actually impact the overall numbers, not the difference in the price of eggs in April. Talking of eggs, food inflation in April was flat again, 0% month-on-month movement and 2.2% for the annual number, bang on where it needs to be, going down every month. Food at home actually went down 0.2% in April and is sitting at 1.1%. We knew this all was coming because the producer data has been coming in low for a while now, but the biggest factor pulling inflation up continues to be shelter. Shelter is at 5.5%, and it was almost 5.6% in this report because of the rounding. If you look at the index and do the math on the calculator, shelter is up 5.5499%. So shelter is proving very sticky, going down very slowly. And a big part of the reason why are the high interest rates themselves. A few days ago, the Federal Reserve Bank of New York published this paper called Housing Price Growth Expectations Increase. Renters express concern for ability to own a home. A main takeaway from the survey is that renters increasingly think they're forever priced out of the housing market. Their self-assessed probability of ever owning a home fell by 4.3 percentage points to 40.1%, a new low in the survey's history. In addition, nearly 3 in 4 renters surveyed said obtaining a mortgage is somewhat or very difficult, compared to 50.5% in 2021. If you missed this report, I strongly recommend signing up to the Daily Upside, who are the sponsors of today's video. The Daily Upside is a completely free daily newsletter written by industry professionals about the most important market and business news. Not only that, but they provide context. See, it's worth noting that this survey took place in February when 30-year mortgage rates were down a full point from their sky-high level of 7.79% in late October. If anything, with rates back above 7%, pessimism could be even worse now. Now, this is really useful data presented in a short email that you can read over a morning cup of coffee. I have read the Daily Upside for years now and am a big fan. And if for whatever reason you don't like it as much as I do, you can always unsubscribe. Go and check out the Daily Upside right now. It'll take you just 5 seconds to sign up. Link in the description. So there is a big problem with mobility at the moment in the US. If you rent, it is very hard and expensive to buy. If you already own a house on a low mortgage rate from a few years ago when you bought it, if you move, you'll be paying a huge amount more per month in interest. House prices in the US are not going up at the moment. The number of house sales is also very low, hovering around 4 million a month. This is the sort of low it was at the bottom of the pandemic, but shelter is still up. And this is because shelter is a lagging indicator in 2 different ways. The first is this: if you live in a house, renting or owning the house, the amount that you pay every month for your rent or mortgage does not change just because the interest rates went up last month or last week, or something in the economy has changed. The only time that you will see a change in what you're actually paying is when you have your annual rent review or when you move, right? Otherwise, your payments are consistent. So when the actual prices on the market change, the consumers don't feel that change until sometime later. until it is time for them to experience that change that has already happened. And the second reason shelter data is lagging is because the biggest part of shelter is the owner's equivalent rent of residences. This is sort of the approximation to the cost of owning a property. They don't get actual mortgage data or actual costs of what people pay when they own the property. They use this equivalent data instead. And it's important to understand what this is and how this data works, because I know there's some people who don't. Every month, the US Bureau of Labor Statistics does a random survey of households, and for those who own their own home, one of the questions is, if instead of owning your property, you were paying rent, how much rent would you be paying? Or it's put another way, if you rent your house out, how much rent would somebody pay you for it? And you can see the problem with this question. First, a lot of people who own their homes don't have a clue what the going rate for rent prices is right now. Their knowledge on this is often erroneous, it is often out of date. They may not be aware of what the latest trend is, what's happening in the last few weeks or the last few months to rental prices in their area. The second issue is that a lot of people who own their home own it outright. Around 40% of homeowners in the United States own their home outright, but inflation data includes them as well in this equivalency data. So these people are not actually paying anything for their home. Their monthly payments are not going up because they are zero. A lot of these people are older as well, from the baby boomer generation, so the homes that they own outright are also relatively expensive compared to the average. So if instead of assuming that they don't pay anything, you assume that they do pay something and that something is increasing using this metric, then you are artificially skewing inflation data upwards. But inflation data just adds the rent equivalent on what they would be paying in that data set. And this number, shelter overall, is 36% of the total inflation figure. So it's a huge component. So if shelter is high, as it is right now, much higher than inflation overall, then it drags the whole index up with it. Real rent increases in the US are at 0 and trending below 0. The latest Zumper report shows smaller properties and apartments sitting just below 0%. But the inflation data is showing rents as going up 5.4%. And this is again because of that time lag between prices changing and people then experiencing that change in the future. And the shelter part of inflation is driven a lot by sentiment. If you're a homeowner, you probably know that rates are crazy high, you hear all this stuff in the news, and you know how much you pay for your mortgage, right? So your estimate of what you could get in the open market in terms of rent is likely to not be up to date. It is likely to not be reflective of actual market rates. We know what the real world number is. The real world number is 0, but it will take time for that trickle through into the inflation data. But let's look at the rest of the numbers. Energy prices are going up for the third month in a row. See, up 2.3% in February, 1.1% in March, and 1.1% again in April. Oil price went up a bit in April, so gasoline prices are up this month. Oil is back down so far in May. Prices at the pump are probably going to take a little longer to go down than they took to go up. And electricity prices are still up 5.1% year on year. By far the biggest part of US energy production is through natural gas. You can find this data with a quick Google, bro. See here, generation from natural gas is almost half of total energy generation in the United States and has been going up consecutively for the last 10 years, while things like coal have been fast going down. This is why the price of natural gas is important and the price of things like coal not so important. Coal usage has dropped 19% in just the last year alone. Natural gas futures were at one of the lowest points in several decades in April. And the way that gas pricing works is a combination of the actual cost of producing energy from that commodity that you get out of the ground and then, convert, or you buy in the past, plus the cost of closing out the difference in your supply on the open market via trading, which is why different types of market prices and futures contracts are very important when it comes to fluctuating short-term prices. Source, I actually worked in energy forecasting and trading, literally forecasting and trading natural gas on the market. But anyway, back to inflation. We saw that shelter is high, but the figure is both lagging and artificially high. Energy is running high, but this is despite commodity prices falling. Profiteering by energy companies is causing prices to stay high, but eventually push has to come to shove. The good news is that this upward pressure is not caused by skyrocketing wages. It is not caused by skyrocketing delivery costs or something else. It's not caused by a general macro inflationary pressure. And then if you look at the overall table, there's also transportation, sitting at 11.2%. And if you look at the detailed data, the thing that's keeping it high is motor vehicle insurance. Some people in the industry say that it's electric cars. Electric cars are way more expensive to repair, so many problems with the batteries. Problem with that argument is that electric cars make up around 1% of the total cars on the road. And they're kind of irrelevant in terms of repair data. So this argument is bullshit. You know what is relevant? The fact that a new reversing camera for my 7-year-old Jeep costs $1,600. And no, it doesn't cost $1,600 because manufacturing that $15 part is much more expensive in China these days. It costs $1,600 because the dealers, the insurance companies, the car manufacturers are greedy fucks and they're ripping people off. That's why. It started during COVID. The whole supply chain shortage. Oh my God, we need to increase prices. That's what the excuse was, and it just hasn't stopped. So again, insurance is definitely an issue. People are definitely experiencing it. Insurance is definitely affecting inflation numbers overall. But there is a limit on how much juice those greedy fucks can squeeze from this lemon. Eventually, something will have to give. The reason that this is actually good news is that the fundamental reasons why inflation is sitting above 2% are not systemic problems with prices. It's not being fueled by a wage price spiral. With inflation as it is, there is pretty much no chance of a rate cut coming anytime soon because the shelter inflation number is moving down very slowly. But key important parts of inflation are all low. Food is 2.2%, medical care services are 2.7%, cars are negative, they're actually getting cheaper. Inflation overall is done. Now it's just a waiting game. How long will it take shelter to come down enough for overall inflation to move towards that 2% goal? Based on the data, it could easily be another 9 to 12 months, I don't know. And in the meantime, we'll keep hearing Grandpa Powell repeat the same gibberish about not understanding the data. We must wait, we must see what happens, because these people don't understand data. High interest rates do not help solve the car insurance issue that we're seeing. High interest rates do not do anything about energy company profiteering. And high interest rates are having the exact opposite effect on inflation when it comes to housing. It's pushing inflation up, not down. There is no reason at the moment for rates to be over 2% higher than the rate of inflation. This is just stupid. But unfortunately, the Fed is just way too old and dumb and way too slow to understand this. So we'll have to wait. The good news is that the US economy is doing great despite the rates. It will be interesting to see what happens in the stock market once the rates do start coming down. And remember to go and subscribe to the Daily Upside, link in the description, and see you later.